Students. So this is a quick revision video of Accounting Standard 11, the effects of changes in foreign exchange rates. So we'll quickly revise what the standard is addressing, what is the accounting treatment of this foreign transactions. The standard addresses three areas: accounting of foreign exchange transactions, foreign operations, and accounting of forward contracts. Foreign transactions, foreign operations, accounting of forward contracts. So first one, foreign transactions. What do you mean by a foreign transaction? Import of inventories or export of finished goods or taking a loan, etc., etc., are the examples of foreign transactions. So foreign transactions are so common nowadays as the entire world is treated as a global village. Yes or no? The entire world is a global village. So I'm traveling to US or purchasing goods from UK, trading with another country, France or Germany. That's not anything great anymore. So as an accountant, how all these transactions will be in foreign currency, right? I cannot transact with Germany, that the currency need not be in Indian rupee. If I'm transacting with UK, the currency need not be in Indian rupee. So how you are going to account in the books? So first of all, I'll give you an example. I'm buying some raw materials worth, say for example, 10 lakhs dollars. When I'm buying on 12th March 2023. Okay, so 10 lakh dollars worth goods I am purchasing on 12th March 2023 or 12th March 2024. 12th March 2024. The settlement is to be made on 5th April 2024. What are the journal entries to be passed in the normal course? If it was an Indian rupee, what are the journal entries that you will be passing? Come on, quick. First entry, purchases to creditors, right? Because you have not made the payment. You made the purchase on 12th March 2024 and the payment is on 5th April 2024. So 12th March you pass the entry purchases to creditors. Is it in your books? Can you record 10 lakh dollars? Of course not, because everything in your books, you are recording all the income, expense, assets and liabilities are recognized in your books at rupees, your home currency, your reporting currency. So this 10 lakh dollars, what you should do? Convert to Indian rupee using spot rate. So that's the first point. So foreign currency transactions, initial recognition is at spot rate. Initial recognition you need to make at spot rate. Initial recognition is at spot rate. Okay. Now there are say for example series of transactions or sometimes identifying the rate or the date of transaction if it is difficult. Say for example, the standard is giving you an option to use average rate of 2 weeks, maximum 15 days. Average rate you can do. See, my transaction was on 12th March. But I don't know the rate on 12th March, but I know the rate on 10th March. The standard says you can use the average rate of, say for example, 1st March and 15th March. You take an average rate that you can use, provided such average rate is not fluctuating significantly, provided there is no significant fluctuations in the average rate. Provided there is no significant fluctuations in the average rate. So foreign currency transactions record initially at spot rate. Okay. Then, or you can use average rate of 15 days, 2 weeks. If there is no significant fluctuations, okay, understood. So initially I recorded it at on 12th March. I have to record it at spot rate on the rate of transaction. Okay. Now settling on 5th April. which means in between there is a 31st March balance sheet date. So what you should do? That balance sheet date, is there any transaction to be done? So my standard, I'm again checking what is given in the standard. My standard says subsequent recognition. Initially you recognized at spot rate. Subsequently, monetary items are to be restated at closing rate and gain or loss to be transferred to statement of P&L. What is that? Again, it is not clear to me. What is that monetary item to be? Monetary items means what? What are monetary items? Monetary items are items to be settled in foreign currency. Here, AS11 point of view, items that are to be required to be settled in foreign currency. Example, you passed your first journal entry, right? Your first journal entry was purchases to creditors. Purchases are non-monetary items. Purchases are non-monetary items. And creditors are monetary items. Why creditors are monetary items? Creditors are to be settled in foreign currency. Are to be settled. Money is to be paid. Payable, receivable or foreign currencies. That is, that creditors will be affected by the fluctuations. Yes or no? Whatever you purchase, say for example, you have purchased a calculator in foreign currency. Now the dollar rate has increased or dirham rate has reduced. It is not affecting the value of this calculator. But if there is a payable, dollar rate goes up, your payable also will go up. Yes or no? Receivable also will go up. So your receivables, payables and foreign currency held. You have $10 in your pocket. Dollar rate goes up. That price, the value is affecting. Yes or no? Yes, yes, yes. So monetary items are those items which is to be settled in fixed monetary terms. So here monetary items we'll consider as foreign currency payables, foreign currency receivables and what? Foreign currencies held. Okay, this monetary items are to be restated. Monetary items are to be restated at what price? At what? It's not correct to say what price, it is what rate. It is to be restated at what rate? It is to be restated at closing rate. It is to be restated at closing rate, which means the rate on the date of balance sheet. Rate on the date of balance sheet. Restate it using rate on the date of balance sheet and gain or loss. Creditors went up. P&L to creditors, P&L foreign exchange loss. Okay. So debtors balance has gone up. So it is profit for you. Debtors debit. Debtors increased means debtors debit. Creditors increase means creditors credit. So that difference gain or loss will be transferred to statement of P&L. Okay. Non-monetary items. Non-monetary items are divided into two. Again division, yes. Non-monetary items are divided into two. Non-monetary items recorded at historical cost. What do you mean by that? Non-monetary items recorded at historical cost. PP. You can follow cost model, or PP you can follow revaluation model. So if PP you are following historical cost model, do not restate. Do not restate. Say for example, inventory. AS2. Inventory you bought from foreign country, imported from foreign country. So cost was $1 lakh. And when you bought that inventory, the dollar rate was 70. And now that inventory, say for example, to measure the NRV, I'm taking, let's take it as $75,000. Now the NRV has come down $75,000. $75,000 into which rate I should take? 75,000 into, is it 70? No, 75,000 into what is the rate on the date of fair value measurement. So you take this as cost and this as fair value. So restate using the rate on the date of fair value measurement. So please sum up. Okay, I'm closing this. Foreign exchange transactions initially recorded spot rate, or there is an option to use average rate of 15 days. Subsequently, all monetary items are to be compulsorily restated. Non-monetary items, if recorded at fair value, you can restate using the rate on the date of fair value measurement. Finished. Oh, so easy. Yes. Now, let me take this illustration number 1. Quickly, okay. Classify the following items as monetary or non-monetary items. What do you think? Inventories are, I can hear, non-monetary. Trade receivables, yes. Settlement in foreign currency, monetary. Investments in equity shares, non-monetary. PPE, non-monetary. Okay, so only one monetary item was trade receivables, which means fixed foreign currency is payable, fixed foreign currency is receivable. That is what monetary item is. Okay, assets and liabilities to be settled in foreign currency. Illustration 2. Goods purchased on 1st January 2011. Okay, $15,000 on that date. Spot rate is 75. Exchange rate on 31st March 11, 74. Year end closing rate. And date of actual payment, it is 73. You are required to ascertain the gain or loss to be recognized for financial year ended 31st March 11, 31st March 12 as per AS 11. So, if we do the journal entries for understanding, what are the entries to be passed on 1st January 2011? Say for example, purchases to creditors or payable, 15,000 into 75. Yes or no? 11,25,000. If you are writing narration and you have to write narration also in exam, if journal entries are asked, being purchases made in foreign currency, okay, or being the purchases recorded at spot rate, recognized at spot rate. Now, will this purchases, raw materials, be affected by the foreign currency fluctuations? No, but the creditors will be definitely affected. So what is the effect of that fluctuation? This 1,25,000 payable is 15,000 into 75, right? 75 will convert ചെയ്തപ്പോഴല്ലേ? Now year end it has become 74. Is it a gain for the entity or loss? Of course it's a gain. 15,000 into rupee 1 is a gain. So what is the entry to be recorded? So you're all saying the entry. Creditors debit. Creditors to be reduced. So creditors are to be debited to foreign exchange income or P&L direct. 15,000. Yeah, correct. Now in my balance sheet, 15,000 into 74, 11 lakh 10,000 is appearing as creditors. Yes or no? On the balance sheet date, my creditors is equal to 11 lakh 10,000. Now on the actual date of settlement, it is 73. Again, it's a good news for the entity. Again, they will pass the entry creditors to P&L. Because eventually you need to settle 15,000 at 73. 10,95,000 and creditors to bank. So easy. Spot rate, closing rate, settlement rate, and gain or losses will be transferred to P&L. You can read the answer. Alam Limited borrowed US dollar 4,50,000 on 1st January, which will be repaid as on 31st July 2011. So which means you borrowed on 1st January 11. So that borrowings, what is the entry when you borrow? Borrow means it's a loan, liability. So liability is to be credited. So I received money, bank to loan. So are you going to record it at $4,50,000? No, at spot rate. What is the spot rate? On 1st January it is 48. Oh, correct. So this entry is all right. Now on 31st March, whatever fluctuations will be definitely affecting me. 1 rupee increased for $1 means I need to repay dollars. So 1 rupee increased. Gain or loss? Of course loss. Foreign exchange loss. Or I am debiting here P&L. Forex loss to loan. Because $4,50,000 into 1. And on 31st July, it has become 49.5. So again, loss to loan, loan to bank. So here it is a combined entry. Loss debit, loan debit to bank. Because you need to pay $4,50,000 into 49.5. Correct. Is it okay? Yes, it is clear. So this is the first part. I'm closing foreign exchange transactions. So foreign exchange transactions. Okay. So what is the second one? Foreign operations. What do you have to say about foreign operations? What do you understand by foreign operation? Accounting of foreign operation. See, foreign transaction is a one-time event. One-time event means there is a debit credit, that's a transaction, or it can be a series of transaction. But foreign operation means having a business connection like a branch or a subsidiary, or having a joint venture or having an associate there. Or you're having a business connection there. It's not just a transaction, you have operation there. Okay. So you have studied foreign branches, right? So what is to be done? So here it is a Indian HO or Indian parent having a foreign branch or foreign subsidiary. Okay. Foreign branch or foreign subsidiary outside India. Then what is to be done? Everyday transaction you are going to translate? No. That foreign operation you need to identify. That foreign operation will be having their own books of account. They'll be having their own books of account. That final trial balance of that foreign operation is to be translated to reporting currency. Understood. The final trial balance is to be translated to reporting currency for preparing the financial statements. That foreign branch or foreign subsidiaries trial should be converted to Indian rupee. That entire trial balance needs to be translated. For the purpose of translation, foreign operation is divided into two. Integral, non-integral. Integral and non-integral. What is integral? Foreign operation is treated as an extended arm of Indian entity. Foreign operation is treated as an extension of Indian operation. It's very important. You should have that foreign operation. Then only you can survive. This Indian company can survive only with that help of foreign operation. That is what integral, very important kind of transactions. Sorry, foreign operation can be integral. That is, foreign operation is treated as an extended arm of Indian entity. or not integral, non-integral, which is not integral. We have a foreign operation there, but there is no much connection. We are doing our business, they have separate line of business there. Okay, fine. So foreign operations for the purpose of translation is divided into integral, non-integral. So this part you know already. Maybe in foreign branch you would have studied share capital. If it is a subsidiary, associate or joint venture branch, there won't be share capital. So if integral, opening rate or rate on the date of issue. Same. Opening P&L, opening rate, same. Current year profits in the trial, convert using average rate, same. Current liability, non-current liability, closing rate, same. Then what is the difference? Why do you need to bifurcate it into integral, non-integral? Yeah, this is the area where there is a difference. Non-current assets. If it is integral, convert using opening rate or rate on the date of purchase of that asset. If it is integral, opening rate or rate on the date of purchase of asset, but if it is non-integral, closing rate. Opening rate, opening stock, opening rate same, closing stock and all other current assets, closing rate. Income and expense, average rate. Depreciation again there is a difference. Which rate is used for converting fixed asset? If integral, you would have used rate on the date of purchase. Then depreciation also rate on the date of purchase. If it is non-integral, you have used closing rate. Then depreciation, closing rate. Now, exchange gain or loss, your trial balance will not tally because each item is converted using a different rate. So, your trial will not tally. So, if it is integral, gain or loss will be transferred to P&L. If it is non-integral, gain or loss will be transferred to foreign currency translation reserve. Foreign currency translation reserve. And in branches you have studied goods sent to foreign branch, cash remitted to foreign branch or cash sent by foreign branch will not be converted. You will use the rate in the books of head office. At what rate we have recorded. When a specific rate is available, we will go for that specific rate. Okay. And gain or loss, integral to P&L, non-integral to foreign currency translation reserve. Pakka. So conversion. So do you need to try a question from the material? If you are saying yes, I'll just quickly try. 7. Illustration 7. Yes. Just one. In your material, a business having head office in Kolkata has a branch in UK. So head office in Kolkata, branch outside India. So machinery purchased on 1st April 2011. If machinery is purchased on 1st April 2011, we need to check whether it is integral. If it is integral, we need specifically rate on the date of purchase. Debtors, always closing rate. Opening stock, opening rate. So goods received from head office account. Goods received from head office, you will not convert because it's given that record in HO books at 4,02,000. So you will not convert 4,02,000. Sales, you will go for average rate. Purchases, average rate. Wages, salaries, average rate. Cash, closing rate. Remittances to HO, again, at what rate it is recorded in Indian books is given. Then HO account, record in HO books, 4,90,000 is given. Creditors, again, current liability, you will go for closing rate. Closing stock, we will not take to trial balance, but we will convert 700 pounds, we'll convert at closing rate. Depreciation, again, whether it is integral or non-integral, we need to know. accordingly. So fixed assets, which rate you are using, same rate will be used for depreciation. So prepare trial balance after being converted in Indian rupee, exchange rate of pounds, opening, closing, not this is not opening, this is the rate on the date of purchase, then opening and closing. So average rate we'll take 63 plus 67 divided by 2, 65. Average rate is 65. So we'll assume, in the absence of information, we'll assume that this is integral operation and we convert machinery using the rate on the date of purchase because it is specifically given. So we'll always, how should I present my answer? In foreign branch also same. You should give the 6 columns. Just copy down the trial balance given. Then conversion, exchange rate to be used, and rupees converted balance. Machinery 5,000 should be converted using 61. Debtors, closing rate. Opening stock, opening rate. Goods received, actuals. Average, closing rate. Actuals, creditors, closing rate. Exchange difference. Because it is integral, it will be taken to P&L, or we would have shown it as exchange difference in FCTR. So closing stock, as I said, in trial it will not come, but we will convert depreciation also using the fixed asset rate. Are you clear? I hope it's okay. Now we have accounting of forward contracts. What do you mean by forward contracts? So forward contract in this particular scenario, AS11 point of view, it's a contract to entered into to buy or sell foreign currency, to buy $1 lakh or to sell $1 lakh at a predetermined rate. So you are entering into a contract on 1st January 2024 to buy $10 lakh on 31st December 24. 1 year later you are going to buy, you need $10 lakh, but you are worried, $10 lakh I need today. Today's rate is 70. So I'm scared, after 12 months, what if it becomes 80? What if it becomes 81? Then it is a loss to purchase dollars at 80. Now you need to pay only 70 rupees and then it is 80 or 81. 10 rupees per dollar loss. So $10 lakh. My God, $10 lakh means 10 lakh into 10, 1 crore loss. So to mitigate that loss, or maybe for speculation, you enter into forward contracts. So what is that? Buying. You entered into a contract to buy or to sell the dollars at a predetermined rate. So this forward contracts can be entered into for hedging. What do you mean by hedging? Really, I need $10 lakh to settle maybe some purchases, or I really need this amount. $10 lakh is required by me. It's a genuine contract. That is what called as hedging. The contract is entered into for hedging purpose. Or maybe this contract is entered into just for speculation or trading. Okay. So the accounting treatment of forward contracts depends on whether the contract is entered into for hedging or whether the contract is entered into for speculation. What if the contract is entered into for hedging? You have entered into a forward contract for the purpose of hedging. What is the treatment? Just listen. Premium or discount from the contract is identified at the inception date. That is the date of that contract, date of that agreement. Premium or discount should be identified at the inception date and amortize it to P&L over the period of contract. So what is this premium or discount? Forward rate minus rate on the date of contract. So it's not clear for me. Okay, then we'll try a question. So Rao Limited purchased plant for US dollar 1 lakh on 1st February 2011. Payable after 3 months. So I'm thinking about what the journal entry is. So plant to payable. Okay, so you genuinely need 1 lakh dollars to pay after 3 months. Yes or no? So company entered into a forward contract for 3 months at 49.15. The rest I have to understand. That is, company entered into a forward contract to buy dollars at 49.15. Exchange rate per dollar on 1st Feb. Today, if I had to settle, then I need to pay only 48,85,000. Because I'm settling and buying after 3 months, I have to pay 49,15,000. So, premium of the contract is 49.15 forward rate minus spot rate. So, how much is the gain or loss? 49.15 minus 48.85, 0.3 into 1 lakh. 30,000 is the expected loss. That you spread over 3 months. 10,000, 10,000, 10,000. You write it off as loss over a period of 3 months. So how do you recognize these transactions in the books of Rao Limited? So let me see. Spot rate 49.15. No. Forward rate 49.15. Spot rate is 48.85. Premium is 0.3. So into 1,30,000. So current year Feb, March, 2 months falling in the current year. So 20,000 loss will be recognized in the current year and 10,000 loss is recognized in the next year. Okay, fine. So this is what I'll do if the contract is entered into for hedging. So what if the contract is entered into for speculation, that is trading? Trading or speculation, ignore premium or discount, and at each balance sheet date, gain or loss is to be identified. So I didn't understand once more. If the contract is entered into for speculation, the premium or discount is not identified. The gain or loss at the end of reporting date is transferred to statement of P&L. Okay, so give me an example. So how do I understand if it is entered into for hedging or entered into for speculation? If the forward contract you entered into to buy and sell the contract, it is for speculation. You genuinely need dollars. That kind of feel will be created in the question. Okay. So let me see. Mr. A bought a forward contract. Not entered, bought. Maybe for sale. You bought a forward contract for 1 lakh dollars on 1st December at $1 is equal to 47.1. When exchange rate is $1 is equal to 47.02. So this is the contract inception. Maybe this is the difference, premium or discount, which you need not consider. Okay. On 31st December, when he closed his books, exchange rate is 47.15. You bought it at 47.1 and when he closed it is 47.15. Exchange rate increased. So we'll assume this is a contract entered into for maybe the contract is entered into to purchase dollars. If the contract is entered into to purchase dollars, using the contract you can buy it at 47.1, but the rate is 47.15 and he sold the contract at 47.18. Show how the profits will be recognized. So how should I write? So there is no feel in the question that this contract is entered into to genuinely need the foreign currency. Therefore, Since the forward contract is entered into for speculation, the premium on contract difference between the spot rate and contract rate will not be recorded. Only the contract is sold, the difference between the contract rate and sale rate will be recognized in P&L. So sale rate is 47.18. Contract rate is I bought it for 47.1, sold it for 47.18. Gain is 0.08. Therefore, 8,000 can be recognized in statement of P&L. That's it. Okay. Understood. Hopefully. Okay. Now there is one more last area which we should not miss when you do AS11. That is an MCA notification, paragraph 46A. MCA notification which is applicable to companies, corporates, which is an optional provision. Say for example, if you have taken a foreign currency loan, long-term foreign currency loan of $10 lakh. So long-term foreign currency loan means it's a monetary item. Yes, it's a monetary item. So the fluctuations are to be taken to P&L. Yes. But this notification says if there is a long-term foreign currency loan, why did you take that loan? This loan is taken to acquire a depreciable asset. Oh, this loan is taken to acquire a depreciable asset. Then the standard says if there is foreign currency fluctuations, if there is dollar rate 70 has become 72, 10 lakhs into 2, 20 lakhs loss will be reported in P&L. So don't record loss in P&L. Instead, that loss can be capitalized. This loss can be capitalized and asset value should be depreciated over the remaining life. Foreign exchange losses to be capitalized. It's optional. It can be credited to P&L, it can be transferred to P&L, or instead it can be adjusted in the value of asset and it will be depreciated over the remaining life. Okay. No, the loan is not taken for depreciable asset, the loan is taken for other purposes. Then the fluctuation loss is to be transferred to FCMITD account. What is FCMITD account? Foreign currency monetary item translation difference. And I didn't understand. Okay, if the rate has become 72, 70 has become 72. There is 10 lakhs. So you can pass the journal entry like this. What journal entry you can pass? FCMITD account to loan. You can pass the entry FCMITD account to loan. This FCMITD account will be amortized over the remaining period of loan. It will be amortized to P&L over the remaining period of loan. Okay, fine. It will be amortized to P&L over the remaining period of loan. So till that date, this FCMITD will be shown under reserves and surplus. Debit balance, it will be shown under reserves and surplus. Okay, so instead of directly taking the long-term foreign currency fluctuations to P&L, it is giving an option. If the loan is taken for depreciable asset, take it to adjust it in the value of asset, or if it is for other purpose, take to FCMITD account. What is FCMITD account? Foreign currency monetary item translation difference account, which will be transferred to P&L over the period of loan. So there won't be a hard hit in P&L. Immediately there is a huge loss. That won't be there. So it will be transferred to P&L over the period of loan. Okay, so that's it. That's with AS 11. So assets, so I'll just quickly take 6, 7 we have already done, then 8. Come on. Assets, liabilities, income and expenditure items in respect of foreign branches, integral foreign operations, are translated into Indian rupees at the prevailing rate of exchange at the end of the year. Assets and liabilities, okay, the two assets, purchase price, the rate on the date of purchase, liabilities closing rate, income and expenditure on average rate, and the resultant exchange differences, profit transfer to other liabilities, wrong, loss to P&L. So comment, just write the provisions. And after writing the provision, write a conclusion. Thus, the treatment by management, translating all assets, liabilities, income and expenditure at prevailing rate at the year end is not in consonance with AS 11. It's not in according to AS 11. Okay, so 7 we have done. 8. Okay. A Limited purchased fixed assets costing 3,000 lakhs on 1st January, and the same was fully financed by foreign currency loan payable in 3 equal annual installments. So you bought a fixed asset for 3,000 lakhs on 1st January 11, and the same was fully financed by foreign currency loan paid in 3 annual equal installments. So exchange rate is 40, 42.5 at the beginning and end of the year. First installment was paid on 31st December. The entire difference in foreign exchange has been capitalized. You are required to state how this transaction would be accounted for. So A Limited purchased 3,000 lakhs fixed assets costing 3,000 lakhs. So which means 3,000 lakhs by 40. 75 lakhs US dollar you have taken loan. Yes. And payable in 3 annual installments. 3 annual equal installments. Okay. The exchange rate 40, and it has become 42.5. First installment is paid. So first installment is paid means what is the entry when you pay the first installment? Always think about the journal entry, then things will be more easy. Both aspects will be clear. So first 75 lakhs dollars you have taken. So the entry would have been bank to loan 3,000 lakhs. Okay, rupees. Then at the end, for what purpose you have taken this loan? What purpose you have taken this loan? Is the loan is taken to acquire fixed asset? Yes. And are you availing paragraph 46 of AS 11, that is MCA notification provisions? Yes. Then it is okay. We'll pass asset to loan. How much? 75 into 2.5. 187.5. But have you taken the loan to to acquire depreciable asset? Yes. But are you availing that paragraph 46A of AS 11? No. Then the entry would have been P&L to loan. So that is totally, that loss will be transferred to P&L. So this totally depends on the assumption which you are taking. So here, just listen. First they have written the entire loss due to exchange difference should be charged to P&L. Okay. The above answer has been given on the basis that company has not exercised the option for capitalization. However, if company opts to avail the benefit, then nothing is required to be done. The company has done the correct treatment by capitalizing the loss to asset. Okay. 9. A Limited has borrowed US dollar 10,000 in foreign currency on 1st April at 5% per annum. Annual interest and acquired a depreciable asset. At 5% annual interest and acquired a depreciable asset. The exchange rates 48 and 51. You are required to pass journal entry if 46A is not availed. 46A is availed. Loan was taken to finance the operations of the entity and not for depreciable asset. In all case, assume interest accrued on 31st March is paid on the same date. Easy, easy, easy. What are the entries to be passed? So first, you have taken loan. Bank to loan 4,80,000. Okay. Then asset to bank 4,80,000. Okay. Now year end. Year end 5% interest is accrued. So let's forget. Interest is there, but there is an increase. If that is not availed, 46A is not availed, what is the entry? P&L to loan. Yes or no? 3 rupees into 10,000. Yes? 3 rupees into 10,000. Yes. So if it is not availed, bank to loan. Asset to bank is not there. Then interest to bank. Anyway, that is okay. Interest to bank is 10,000 into 5% is the interest. And when you pay it, you need to pay 51 rupees. Okay. Then P&L to loan. Same set of entries. If 46A is availed, then instead of P&L it will be asset. So this bank to for loan, interest. The rest is all fine. You need not pass foreign exchange loss to loan, then PP to foreign exchange loss. You can pass a single entry, PP to loan. If availed, it can be capitalized to asset. Then if it is for something else, then these entries are all correct. Then instead of transferring it to P&L or asset, we can transfer it to foreign currency, monetary item, translation difference account. Okay. That's it. Okay. As per AS 11, assets and liabilities of non-integral foreign operation should be converted at assets and liabilities of non-integral closing rate. Good. Debit and credit balances of FCMITD account, whether debit balance or credit balance, it will be shown under miscellaneous expenditure, no. Shown under reserves and surplus, yes, B. I'm not reading further. If asset of an integral operation is carried out at cost and depreciation of tangible fixed asset is translated at exchange rate at the date of purchase of asset. Which of the following can be classified as integral? Branch office serving as an extension. Independent subsidiary. Branch office independent of head office. None of the above. No way. Branch office serving as an extension of head office. Then which of the following items should be converted to closing rate for the purpose of financial reporting? PP, inventory, trade payables, trade receivables, foreign currency, borrowings, all of above. It's not about translation. It's in the financial statements. It's no information regarding it's a foreign branch, foreign operation. So PP, no. Inventory, no. This trade payables, trade receivables. If it is foreign operation, all of the above. Okay. So 5, let me see. So foreign operation they have not mentioned. So trade payables, trade receivables. Okay. C, B, C, A, C. C, B, C, A, C. Okay. Theory questions I am not reading. Explain briefly. So theory questions I am not reading doesn't mean that theory questions will not come. It can come. But that theory might have discussed already in the class. So just read it. Explain briefly the accounting treatment needed in the following cases as per AS 11. Trade receivables include amount receivable from Umesh, 5 lakhs. Recorded at prevailing exchange rate 58.5. So from Umesh, 5 lakhs divided by 58.5. 8547 dollars. 8547 dollars was receivable. Long-term loan from a US company amounting to 60 lakhs. It was recorded 55.6. 60 lakhs divided by 55.6. 1,07,913.66. Taking exchange rate prevailing on the date of transaction 61 point. Okay. 31st March it is 61.2. So we'll write $8547 initially recorded 58.5, closing rate 61.2. So record 61.2 minus 58.5, 2.7 gain. Debtors to P&L. So here 61.2 minus 55.6 into 1,07,913.66. 60 lakh 43 6 lakh 4,316.5 loss. P&L to what? P&L to loan. Okay. So Umesh, trade receivables, initially 8547, gain, difference, credit P&L. Yes. Then long-term loan, 60 lakhs divided by 55.6, 1,07,913.7, difference. Debit P&L. Debit FCMITD if you are availing 4646A, FCMITD account can be debited. Okay. So that's it. So AS11 is done. So like this, if any area you need to discuss, please let me know. Any question specifically, if you need to have a revision, we'll do that. So that's it. So thank you everyone. Happy learning.